The global economic crisis and the policy response to the crisis have caused interest rates to fall to record low levels. In this short presentation, I'm going to tell you why I think that's happened and what I think is likely to happen next. Okay, I won't keep you in suspense. While interest rates are not going to remain low forever, I do believe they're likely to remain low for the foreseeable future, let's say the next 1 to 2 years. In fact, they could go lower. I wouldn't be surprised if the yield on the 10-year government bond falls below 1% before interest rates bottom. Let me explain why, beginning with the causes of the crisis. Okay, this chart shows total credit or total debt in the United States. Notice that it first went through $1 trillion in 1964. And then over the next 43 years, it expanded 50 times to $50 trillion. And now it's $64 trillion. So as this credit exploded, that created the greatest economic boom in history. But in 2008, when that credit couldn't be repaid, this global boom started to bust. Now in this chart you can see the ratio of total credit to GDP. From 1950 up until about 1980, it was around 150% of GDP. But then it started moving up. And by 2007, it hit 370% of GDP. So as credit expanded, the credit growth drove economic growth. But then the bubble popped. And here we came very close to collapsing into a new Great Depression. It's important to understand that the Great Depression, and this new depression as I call it, came about for more or less the same reasons and evolved in very similar ways up until at least the time of the policy response. So let me go through that. The Great Depression, in my opinion, originated in World War I, when all the European countries went to war with each other. And they went off the gold standard because they didn't have enough money to fight the war. So they all started issuing a lot of paper money and enormous amounts of government bonds. So all of that paper money and government debt created a worldwide credit bubble that we call the Roaring Twenties. But that boom turned to a bust when all of the credit couldn't be repaid. And then the banking sector collapsed and international trade collapsed. And at that point, policymakers just really didn't know what to do. They believed in laissez-faire and market forces, so they really didn't do very much of anything. They just let market forces work. And so that's what happened. Market forces did work, but market forces determined a new market-determined equilibrium in which the level of GDP was 50% lower than it had been in 1929. And the level of unemployment ranged from 15% to 25% for the entire decade of the 1930s. And the Depression didn't end until World War II started. And at that point, then US government spending increased by 900%, and that put an end to the Depression. All right, well, this time the causes have been really quite similar. In 1971, the Bretton Woods system broke down. That was more or less a quasi-gold standard. Afterwards, credit exploded, and that created a new global economic bubble. But in 2008, the credit couldn't be repaid, and that bubble started to pop. The international banking system started to collapse, and global trade started to collapse. But this time, the policy response has been entirely different, because policymakers are terrified that if they don't respond differently, we'll collapse again into a new Great Depression. So when the bubble popped this time, policymakers responded by reflating the bubble. Government budget deficits soared, interest rates were cut to zero, and quantitative easing pushed up asset prices, creating a wealth effect that fueled consumption and drove economic growth. So here you can see the US budget deficit as a percentage of GDP. It peaked at almost 10% of GDP in 2009, and for 4 years it remained above $1 trillion a year. It's now come down very significantly. The federal funds rate was cut to 0% at the end of 2008. And here, notice that this goes back to 1980. So with every recession, the federal funds rate has moved to a lower and lower level. So in the recession of 92, the federal funds rate bottomed at 3%. And then in the recession of early 2000s, it bottomed at 1%. This time it went to 0%, and on top of that, there was quantitative easing. So the chances are very high that during the next recession, the federal funds rate will once again move back down to 0 and we'll have even more quantitative easing. And also the Fed created $3.6 trillion since the crisis started. This is the Fed's balance sheet, their total assets. And with that $3.6 trillion, the Fed bought financial assets, mostly government bonds and mortgage-backed securities issued by Fannie and Freddie. As a result, household net worth rose by $33 trillion, or by 61%, between the post-crisis low of the first quarter of 2009 and now. So this $33 trillion increase in wealth had an enormously positive impact on the US economy and the global economy. All right, so where does that leave us? Now, in this chart, once again, you can see the ratio of total debt to GDP in the US, and also now this time the federal funds rate. So notice that as interest rates fell, this goes back to 1980, as interest rates moved lower and lower, the ratio of credit to GDP expanded because the lower interest rates made a greater level of debt possible. It made it affordable. As interest rates moved down, credit could expand. And as the credit expanded, the economy grew. But now we're at the point where if interest rates begin to rise, then credit is going to contract and the economy is going to go back into severe recession. Right now, I'm certain you're more interested in mortgage rates than the federal funds rate. And of course, the mortgage rates move in line with government bond yields, not in line with the federal funds rate. So in this chart, we have the 30-year fixed mortgage rate in black and the 10-year government bond yield in blue. And you can see they move quite closely together, as you know. And in this chart, we have the 10-year government bond yield and the federal funds rate. So the Fed can control the federal funds rate, but it can't always control the yield on the government bonds. Notice that the 10-year government bond yield fell even after the Fed hiked interest rates last December. So what does determine the yield on government bonds? Well, the supply and demand for bonds determines the yield. The supply is determined primarily by the government's budget deficits and how many bonds are sold to finance those deficits. So here we have a chart showing the government budget deficits between 2005 and estimates from the Congressional Budget Office going out to 2018. So this is 2015. You can see they're much lower than they used to be. And they're expected to expand a little bit for the next couple of years and then contract a little bit in 2018. Now, demand for government bonds is determined by quantitative easing, the yield on other government bonds around the world, and the inflation rate. So let's look at these. Clearly, when the Fed prints money and uses it to buy government bonds, that pushes up the price of the bonds and pushes down their yields. But quantitative easing by other central banks also affects US government bond yields in two ways. First, directly, when the other central banks use the new money that they print to buy dollars and then to buy US government bonds. And indirectly, when those central banks use the new money to buy their own government bonds, that pushes down the yield on their bonds and makes US government bonds more attractive by comparison, attracting buyers to US government bonds. So for example, again, here we have the federal funds rate in red and the 10-year bond yield in blue. Now this period, 2004 and 2005, the Fed at this point was trying to slow the economy down and slow the property bubble down, and they hiked interest rates, the federal funds rate, I believe 17 times. But you can see the 10-year government bond yield barely budged during this period. So they had lost control over the bond yields and interest rates. Now, some senator asked Alan Greenspan, who was then chairman of the Fed, why is this? Why have you've increased the federal funds rate 17 times, but the bond yields haven't gone up? And Greenspan replied, I don't know, it's a conundrum. Well, I'm not sure he was telling the truth about that, because it's pretty clear what was happening during this period. During this period, central banks outside the United States, primarily those of the trade surplus countries like China and Japan, South Korea, Taiwan, Saudi Arabia, those countries were printing a great deal of their own money and using it to buy dollars in order to hold down the value of their currency. And then they took those dollars and they bought US government bonds with them. And so that pushed up the price of US bonds and pushed down their yields. So that you can say that was quantitative easing done by the central banks of the trade surplus countries. And we can monitor that by looking at the total foreign exchange reserves in the world. So here, that's what we have here. This goes back to 1948 and up to 2015. Now notice that between the year 2000 and 2012, in that 2014, in that 14-year period, total foreign exchange reserves increased by $10 trillion. Now, I estimate that more than 70% of all reserves are held in US dollars. So foreign exchange reserves go up when central banks outside the US print money and use it to buy the currencies of other countries in order to hold down the value of their own currency. They then use the newly acquired foreign currencies to buy foreign assets, mostly government bonds. And 70% or more of all these foreign exchange reserves are in dollars. So during this 14-year period, foreign central banks printed the equivalent of $10 trillion of their own currencies, and they used it to buy foreign exchange, 70% of which was dollars. So they acquired 7 trillion US dollars, and with that they bought $7 trillion of US dollar-denominated assets, mostly government bonds. And so that pushed up the price of the bonds and it pushed down their yields. And that explains the conundrum of 2004 and 2005. All right, next, the yield on foreign bonds also affects US government bond yields. The Bank of Japan and the European Central Bank have conducted very aggressive quantitative easing programs over the past 2 years. That has driven down the yield on their 10-year government bonds below zero. Negative yields in Japan and Europe have made the higher yields available on US government bonds look very attractive. So that has attracted buyers for US bonds, which has pushed up their price and pushed down their yields. All right, now in this chart, I provide data on what the central banks have been doing. The Bank of England, the Bank of Japan, and the European Central Bank. The Bank of England has just launched its third round of quantitative easing recently. They're now printing the equivalent of $11 billion a month, or $34 billion a quarter. The Bank of Japan is much more aggressive. They're printing the equivalent of $67 billion a month, or $200 billion a quarter. And the ECB is most aggressive of all, printing the equivalent of $90 billion a month, or $270 billion a quarter. So altogether, these three central banks are printing the equivalent of more than $500 billion every 3 months. And those three central banks, combined with the Fed, which isn't printing right now, but altogether those 4 central banks have printed more than $8 trillion, which they've used primarily to buy government bonds. Here you can see the totals. And this 8 trillion, 8.1 trillion, this is going to increase by $1 trillion every 6 months, since these 3 central banks are still printing so much. And now altogether, the Bank of England has already bought up 25% of all English government debt. The Bank of Japan has acquired 35% of all Japanese government debt. The European Central Bank has acquired 12% of all Euro area government debt. And the Fed has acquired 13% of all US government debt. So the central banks have greatly reduced the amount of bonds left in the market that are available for others to buy. So by taking out so much of the supply of bonds, that's pushed up the price of the bonds and pushed down their yields globally. So this chart shows Japanese government bond yields. This combination of very low inflation and quantitative easing has pushed the government borrowing costs to record low levels. They are negative in Japan. They're negative in Europe. This shows the yield on European government bonds, 10-year bonds. In the UK, the 10-year government bond yield is now 80 basis points. It was 2% as recently as last November. And in the US, the 10-year government bond has come down to 1.7% yield. So this money printing has changed everything. Government borrowing to finance the budget deficit used to be the most important swing factor impacting government bond yields. But once central banks began printing money on a very large scale and using it to buy government bonds, the demand for bonds from central banks has become increasingly important and is now the most important determinant of government bond yields, because there is no limit as to how many bonds the central banks can buy. And that means the central banks can control the bond yields at any level they like. Now, finally, inflation also affects the demand for bonds. If the inflation rate goes up, the demand for bonds will go down unless the yield offered on those bonds increases. But the inflation rate has been exceptionally low, despite all of the money that central banks have been printing. In 2015, US CPI was only 0.1%, practically zero. So why is that? Globalization. It's globalization that explains why inflation has been so low. Before globalization, each country had a relatively closed economy. Those economies experienced inflation when the domestic labor force and the domestic production facilities were fully utilized. But now we have a global economy with a labor force numbering in the billions instead of the millions, and production facilities that stretch around the world. That means that domestic bottlenecks are now irrelevant. Consequently, inflation is no longer ignited by domestic constraints. And the global economy is very far from hitting full capacity. 2 billion people live on less than $3 a day. Seemingly limitless credit growth in China has produced excess capacity there across almost every industry on a mind-boggling scale. Furthermore, ultra-low-cost labor in developing economies like China, India, Vietnam, and Bangladesh, where a rapidly growing share of the world's manufacturing now occurs, greatly reduces the cost of production, allowing manufactured goods to be sold in the United States at much lower prices than in the past. Inflation is also low because the global economy is weak, China's economic bubble is deflating, and the Chinese RMB is being devalued. Okay, so what's next? Monetary policy is approaching exhaustion, not because the central banks can't push interest rates lower, but because interest rates are already so low that lower rates could begin to do more harm than good. Savers, pension funds, insurance companies, and banks would all suffer from lower interest rates. Also, very low interest rates have pushed asset prices up so much that valuations are now becoming very stretched. And this is increasing the risk of a new market crash. In this chart, what we have is the ratio of household net worth to disposable personal income. So you can think of this ratio as the ratio of wealth to income. This goes back to 1951. So you can see it averaged somewhere around 525% during most of this period. But in 2000, when we had the NASDAQ bubble, it went above 600%, and then it crashed with the NASDAQ correction. And then in 2007 and 8, it went up above 650%, and then it crashed. And now, because of quantitative easing, this has moved back up almost to 650%. So asset prices are very stretched and could easily move down sharply once again. With monetary policy nearing exhaustion, fiscal stimulus would be the best way to keep the global economic bubble inflated now. Increased government spending would be easy to finance since interest rates are so low. And if large-scale government borrowing began to push up interest rates too far, the Fed could launch a fourth round of quantitative easing and finance the additional government borrowing, which would push interest rates back down again. I think we probably will get some fiscal stimulus after the next president takes office in January, but how much remains very uncertain. Now, if something goes wrong and the global economic bubble does pop, then there's going to be deflation. In that scenario, US government bond yields would move down much closer to 0%. And then the Fed would launch another round of quantitative easing in the attempt to reflate the bubble one more time. If conducted on a large enough scale, QE4 probably would succeed, but interest rates would be lower than they are now. All right, so let's talk about some risk for bonds. An inflation shock is the greatest worry. Any kind of inflation shock would be catastrophic for bond prices. So what could cause such a shock? Well, first, tariffs on imports into the United States, such as the ones Donald Trump has said he would impose on Chinese and Mexican goods, would immediately push up inflation and cause bond yields to soar and bond prices, stock prices, and property prices to crash. So here we could say that Trumpthing could go terribly wrong. Second, a war that disrupted the supply of oil or that resulted in the breakdown of globalization would also cause high inflation. And fiscal stimulus on a very large scale could also push up inflation. But if it did, that would mean the economy had strengthened enough so that the stimulus could be curtailed, in which case the inflation rate would come back down. Now, any political interference with the Fed could also cause interest rates to spike. Now, if inflation picks up, what then? Okay, there are several ways our new global economy works differently than national economies used to work in the past. For instance, there's a new policy tool available to combat inflation in the United States and other developed economies. It's Chinese devaluation. The US imports $500 billion worth of goods from China every year. Devalue the Chinese RMB, and they all immediately become much cheaper. That way, the Fed could avoid hiking interest rates, and the global economic bubble could remain inflated. China would be more than happy to devalue if asked. Global policymakers are terrified the world is going to collapse into a new Great Depression. And therefore, I believe they'll do whatever it takes to prevent that from happening. They have plenty of tools at their disposal if they will just use them. Fiscal stimulus could be deployed on a very large scale to generate demand and to prevent deflation. Quantitative easing could be used to finance the fiscal stimulus and to keep asset prices inflated. And Chinese currency devaluation could be used if inflation begins to rise too much. All right, so in conclusion, a pessimist would say that everything eventually ends badly. And of course, ultimately, that's correct. But a lot of time can elapse between now and eventually. The global economic bubble came quite close to ending very badly 8 years ago, but it didn't. Policymakers managed to keep it inflated. I believe they will continue to find a way to keep the bubble inflated for the foreseeable future. But low interest rates are going to be necessary to make that happen. Policymakers want and need interest rates to remain low. That's why I believe rates will remain low or go even lower. That said, I would much prefer to be a borrower of fixed-rate mortgages than a lender. Many things could go wrong with the relatively optimistic scenario that I've outlined in this presentation. Now, a few questions and answers here. First, what's the likely range for interest rates over the next 2 years? Okay, well, so far I've just suggested that the 10-year bond yield will be low or go lower. But of course, there's going to be some fluctuation. It is possible the 10-year bond yield could go back to 2.5%, but I would be surprised if it goes as high as 3% within the next 2 years. Now, the federal funds rate, the Fed may begin hiking interest rates on the federal funds rate. I'm not certain that they will, but I doubt if they'll be able to increase rates by 100 basis points before the economy weakens and moves back into the next recession, at which point they'd have to cut them again. Right. Second, if there is fiscal stimulus, how will that impact interest rates? Well, if there's a large-scale fiscal stimulus, then the government would borrow more, and that would tend to push up interest rates. But in that case, I would think that the Fed would respond by launching another round of quantitative easing to finance the additional government borrowing. So this is what many people now refer to as helicopter money. That's probably on the horizon. And I think that's a very good scenario. That would be the best scenario for the economy for the foreseeable future. The fiscal stimulus would create demand, it would create jobs, the economy would grow, and at the same time interest rates could remain low so that the asset price bubble doesn't pop. Okay, third, is China's economic slowdown ending? If so, how will that impact US interest rates? Well, no, I don't think China's economic slowdown is ending. China has an enormous economic bubble. They have massive excess capacity across all industries. They don't have sufficient domestic demand to absorb all of that capacity. And the global economy doesn't have sufficient demand to absorb all of China's excess capacity. So investment's going to have to slow. China's economy is going to keep deflating. And most probably the Chinese currency is going to continue being devalued further. So all of that's likely to put downward pressure on US rates rather than upward pressure. Okay, next, is monetary loosening in Japan and Europe about to end? And if so, how will that impact US interest rates? Well, again, no, I don't think that monetary loosening in Japan and Europe is about to end. The QE in Japan seems to be more or less open-ended. In Europe, quantitative easing is scheduled now to end in March 2017, but that's likely to be extended also. So in both the case of Japan and Europe, I think it's likely that interest rates on their government bonds are going to remain very close to 0%, which should continue to put downward pressure on US interest rates. Okay, and finally, what are the economic implications of the aging of America? So yes, the Americans are aging, the baby boomers are retiring, and this does create longer-term problems for the economy. It means that the potential growth rate for the United States now is much closer to 2% than 3% as it used to be. But in my opinion, this is a long-term issue, a long-term problem, whereas we have a lot of short-term problems that are going to be on our immediate horizon in the years immediately ahead. So I'm not so concerned about demographic trends in the short term. And even in the long run, looking out, say, 20 to 30 years from now, I believe that we're probably not going to have the sort of Social Security crisis and Medicare crisis that many people fear, because we have such a technological revolution underway now. I believe that Americans are going to become much healthier and live much longer and be able to work much longer than they currently do. So people who expect that the Americans are going to continue retiring at the age of 60 or 65 are probably going to be surprised when life expectancy becomes very much longer. And that will resolve, I think, the long-term problem here. But in any case, we have many more things to worry about in the short term than demographic trends.